I studied every major market crash in the last 100 years, and I realized they all start exactly like this. Most people think market crashes are random events. They are not. After analyzing the data, I found that every single major crash follows the exact same 5-phase pattern. It doesn't matter if it's 1929 or 2025. The technology changes, but the human psychology remains exactly the same. In this video, I am going to walk you through these 5 phases. Phase 1 is the start of the crash. This is the trigger event that breaks the trend. Phase 2 is the false rally. This is the trap where most investors lose their money. Phase 3 is the panic selling. This is where fear takes over and prices collapse. Phase 4 is the market bottom, the point of maximum despair, where the opportunity is highest. And Phase 5 is the recovery, the wealth transfer, where the next generation of billionaires is made. For every major financial market crash that happened in the last 100 years, from the Great Depression of 1929 to the COVID-19 crash of 2020, I will show you exactly what happened during each phase, what led to it, and how long it lasted. I will also break down how the various market participants, governments, and regulators reacted to it. By the end, you will have a complete, clear understanding of these 5 phases. You will see how a very few smart people made millions and even billions of dollars during these crashes in history. And most importantly, you will get the key learnings you need from this extensive research to position yourself the best way for the next market crash. Because the market crash is not a matter of if, it is when. Let's begin with Phase 1, the start of the crash. To understand the start, we have to look at 1929, the Roaring Twenties. The narrative was that we had reached a permanently high plateau. Everyone believed stocks would go up forever. But the trend broke in October because of one critical flaw: margin debt. People were buying stocks with borrowed money, with only 10% down. There was almost no effective federal regulation. When the selling started, that leverage turned a small dip into a massive margin call cascade. But we have to be accurate here. Margin debt accelerated the crash, but it wasn't the only cause. The economy was already slowing down. There was massive overproduction in factories and agriculture. Companies were making more products than people wanted to buy. Plus, the banking system was incredibly fragile, with thousands of small, rural banks that had very little capital. So when prices started to slip, it wasn't just a market correction. It was a loss of confidence in the entire economic structure. That's what turned a dip into the Great Depression. Now let's fast forward 58 years to Phase 1 of the 1987 crash, Black Monday. The trigger here was completely different. It wasn't overproduction. It was a new financial technology called portfolio insurance. Institutional investors used computer programs designed to automatically sell futures contracts if the market dropped, theoretically to protect their gains. But on October 19th, a small decline triggered these computers to sell. That selling drove prices down further, which triggered more computers to sell. It created a mechanical feedback loop that no regulator understood at the time. The market fell 22.6% in a single day. The regulators were blindsided because they were watching the economy, but the crash was caused by the market's own internal structure. Next, look at Phase 1 of the dot-com bubble in the year 2000. The narrative was the new economy. Investors believed the profits didn't matter, only clicks and eyeballs mattered. Valuations were mathematically impossible. The break happened when the Federal Reserve raised interest rates and Japan entered a recession. Suddenly, cash became expensive. Investors looked at the quarterly reports and realized these tech companies were burning cash with zero path to profitability. The growth at all costs story died instantly. In 1929, it was structure. In 1987, it was machines. In 2000, it was valuation. But in 2008, Phase 1 was about credit. The global financial crisis didn't start with a stock market crash. It started in the bond market and the housing market. The narrative was that national housing prices never go down. Banks bundled risky subprime mortgages into complex bonds and sold them as, quote, safe investments. The trigger was when homeowners started defaulting in 2007. Banks realized the assets on their balance sheets, which they thought were worth billions, were actually worthless. Confidence between banks evaporated. They stopped lending to each other. This is crucial to understand. 2008 wasn't just prices falling. It was the infrastructure of the global financial system freezing solid. And finally, Phase 1 of the COVID-19 crash in 2020. This was the fastest Phase 1 in history. In January and February 2020, the US stock market was hitting all-time highs. The dominant narrative was, it is just a flu in China. It will not affect the US economy. The break happened in late February. The news shifted overnight from local issue to global pandemic. countries started locking down borders. This was not a financial structural failure like 2008 or a valuation bubble like 2000. It was an exogenous shock, an external event that forced the entire global economy to stop generating revenue instantly. The S&P 500 fell 34% in just 33 days. It was the fastest bear market in history. The speed was the defining characteristic here. So phase 1 is always the wake-up call. The narrative breaks. The trend reverses. But this brings us to the most dangerous phase of all. Phase 2. Phase 2, the false rally. In trading terms, this is often called a bull trap. This is the phase where the initial panic stops, and prices start to go back up significantly. Smart investors use this liquidity to sell their positions, while amateur investors think the crash is over and buy. Let's look at the most famous example, 1929. After the initial crash in October 1929, the market did not just go straight down. Starting in November 1929 and lasting until April 1930, the market rallied nearly 48%. 48%. Think about that. If you were an investor in early 1930, you saw stocks recovering half their losses. President Hoover was giving speeches saying the worst was behind us. Newspapers were calling it a great buying opportunity. The fear vanished. People borrowed more money to buy back in, thinking they were getting a discount. But the economic data, production, employment, bank stability, was still collapsing. The price was going up, but the value was going down. When the rally ended in mid-1930, those investors were trapped. They held all the way down to 1932, losing 89% of their money. This false rally destroyed more wealth than the initial crash. We saw the exact same thing in the dot-com crash of 2000. The Nasdaq did not pop in one day. It fell, then rallied hard. In April 2000 and May 2000, there were weeks where tech stocks jumped 10% or 20%. Investors said tech is the future, this is just a correction. They bought the dip, but every rally was a lower high. The trend was down. The market lured investors in, took their cash, and then broke to new lows. This happens because of denial. It is painful to accept that the party is over. So the market creates a story that gives you hope. But hope is not a strategy, and relying on headlines during a false rally is financial suicide. The problem is that during a false rally, the financial news industry works against you. They are paid to keep your eyes on the screen, so they amplify the hype. They will tell you to look at the stock price. But as we saw in 1930 and 2000, the stock price is a liar. You need to look at the economic data. But which data? There are thousands of indicators. If you don't have a filter, you will get trapped. I realized that most people lose money, not because they are stupid, but because they are looking at the wrong signals. That is exactly why I wrote this book, How to Read the Market. I did not write this to give you stock picks. I wrote this to give you a professional-grade process. A step-by-step guide to analyzing financial news, understanding economic indicators, and making confident investment decisions. Inside, I break down a specific 3-step mental framework. First, filter the noise. You will learn how to instantly identify whether a headline is a signal worth analyzing or just noise designed to scare you. Second, read the vital signs. I show you how to deconstruct the 5 key reports, from GDP and inflation to the jobs report, that actually drive market trends, so you can ignore the pundits and read the raw data yourself. And third, master your psychology. We tackle the biological flight or fight response that leads to panic selling. I give you a pre-investment checklist to make calm, high-probability decisions, even when everyone else is losing their minds. This book is the manual I wish I had when I started. It transforms you from a passive consumer of entertainment into an active financial detective. If you want to stop guessing and start analyzing, you can grab a copy right now. Just scan the QR code on the screen or click the link in the description. Get the knowledge now, before the volatility hits. Now let's move to the moment where the trap snaps shut. Phase 3. Phase 3. The panic selling. This is the capitulation. This is the moment when the false rally fails. The hope dies. The investors who bought the dip realize they were wrong, and they rush to the exit all at the same time. Prices do not glide down gently, they gap down vertically. And this brings me to my personal experience. Because I watched Phase 3 happen in real time in March 2020, and it taught me the most painful lesson of my life. It was mid-2019. I was 16 years old. I had just started to get fascinatingly obsessed with the financial markets. I realized this was my career path. I was at that decisive age where I had to choose my future, and I chose finance. But I was a minor. I couldn't even legally open a brokerage account. So I opened one using my father's ID. For months, I studied everything: fundamental analysis, technical patterns, derivative strategies, macroeconomics. I wasn't just gambling, I was building a solid foundation of knowledge. I was trading with very little money, just testing my strategies, waiting for the big opportunity. Then, March 2020 hit. I sat there and watched the markets collapse. I saw blue-chip companies trading at valuations I hadn't seen in textbooks. I saw the panic, but because I had studied the history, I didn't feel fear. I felt greed. I knew, mathematically, that this was the buying opportunity of a lifetime. I understood the macro environment. I knew the recovery would come. But then, reality hit me harder than the crash. I was a student, doing my intermediate studies. I had the knowledge. I had the strategy, but I didn't have the cash. I watched the wealth transfer of a generation happen right in front of my eyes, and I was sidelined. Not because I wasn't smart enough, but because I didn't have enough cash. That experience taught me the brutal truth about Phase 3. Knowledge without capital is torture. Most people don't buy during the panic because they are scared. But a very few, the ones who actually understand the market, don't buy because they are broke. They are fully invested, or they lost their job, or they have no reserves. You need to understand that market crashes recover. Sometimes it takes months, sometimes years. But to capture those massive gains, you need to survive the drawdown and have fresh cash to deploy at the bottom. Look at Warren Buffett. Look at the biggest hedge funds. Why do they hold billions in cash, earning nothing? It's not because they are lazy. It's because they view cash as an option to buy future assets at a discount. If you go into the next crash with zero cash reserves, you are powerless to save your financial future. So how do you know when to deploy that cash? How do you know when the panic selling stocks and the opportunity begins? That brings us to Phase 4. Phase 4, the market bottom. Phase 4 is the point of maximum despair. This is when the last optimist finally gives up and sells. Identifying the bottom is the hardest skill in investing, because it always feels like the world is ending. The news is at its absolute worst, but the price stock's going down. Let's look at the Great Depression. The bottom didn't happen in 1929 or 1930. It was a slow, agonizing grind that lasted until July 1932. The Dow Jones Industrial Average hit a low of 41.22. That is an 89% drop from the top. 89%. At that point, there was no hope. Banks had failed. Unemployment was 25%. The bottom formed not because of good news, but because there was literally no one left to sell. Everyone who could sell had sold. This is called seller exhaustion. Now compare that to 1987. The bottom happened almost instantly. Why? Because the Federal Reserve stepped in immediately. On Tuesday morning, before the market opened, they announced they would provide liquidity to the banks. This was the birth of the Fed put. The market bottomed because the government promised to flood the banking system with cash. In the dot-com bubble of 2000, we saw a different beast. It wasn't a sharp V like 1987, and it wasn't a total systemic collapse like 1929. It was a slow bleed. The bottom didn't hit until October 2002. That's 2.5 years of pain. The Nasdaq fell 78%. It bottomed only when valuations finally made sense again. The hype was completely washed out, and tech stocks were finally trading at earnings multiples that real investors would pay for. So bottoms can take years like 1929 and 2000, or days like 1987. But what about the modern era? 2008 and 2020 changed the rules entirely. In 2008, the bottom formed in March 2009. The S&P 500 hit the devil's number, 666. But it didn't stop falling because the economy was fixed. It stopped because the rules changed. The accounting standards were relaxed, and the government effectively guaranteed the entire banking system. And then, the most aggressive bottom in history, March 23, 2020. The economy was still shut down. Uncertainty was at an all-time high. Yet, the market bottomed that exact day. Why? Because on that morning, the Federal Reserve announced unlimited QE. They literally said they would print as much money as needed to buy government bonds and corporate debt. The market didn't care about the virus anymore. It only cared about the liquidity. The bottom was not driven by fundamentals. It was driven by the printer. This is the key lesson for the next crash. The bottom happens when the pain of falling becomes greater than the cost of printing. When the government panics, you buy. Once the bottom is in, we enter the final phase, Phase 5, the recovery. This is where fortunes are made. But not all recoveries are created equal. You need to know which shape we are in. Let's start with the nightmare scenario, the 1929 L-shape. After the 1932 bottom, the market didn't just bounce back to all-time highs. It took 25 years, until 1954, for the Dow Jones to reach its 1929 peak again. If you bought the top in 1929, you waited a quarter century to break even. But if you bought the bottom in 1932, you made a fortune in dividends and slow growth, even before the prices recovered. Contrast that with the 1987 shock recovery. Because the economy was actually strong, and the crash was just a technical glitch, and some minor economic concerns, the market recovered its entire loss in just 2 years and hit new all-time highs. Traders who sold in panic on Monday felt like geniuses. By Wednesday, they felt like idiots. By Friday, they were broke. The lesson here: never panic sell a technical crash if the economic fundamentals are solid. Now look at the 2000 U-shape. This one is tricky. The Nasdaq took 15 years to recover. If you bought Intel or Cisco at the top, you might still be underwater today, adjusted for inflation. But here is the secret. The entire market didn't take 15 years. Old economy stocks, banks, energy, retail recovered much faster. The wealth transfer in Phase 5 wasn't just buying, quote, the market. It was rotating from the overvalued bubble, tech, to the undervalued assets, value stocks. This brings us to the two most recent recoveries, which have defined modern investing: 2008 and 2020. 2008 was the start of the asset inflation era. The recovery from 2008 wasn't just about businesses selling more products. It was about interest rates hitting zero. When money is free, assets go up: real estate, stocks, bonds, everything inflated. It was a U-shape for the economy. Unemployment stayed high for years, but a V-shape for asset prices. And finally, the 2020 V-shape, the fastest recovery in history. If you bought the S&P 500 on March 23, 2020, you doubled your money in months. Some tech stocks did 5x or 10x. This happened because the Federal Reserve nearly doubled its balance sheet, injecting trillions of dollars into the system in just a few months. The recovery was artificial, but the profits were very real. So we have analyzed 100 years. We have seen the 5 phases in action across 5 different crashes. Now, the most important question: how did the smart money make billions while everyone else was panicking? They followed a simple 3-step playbook that you can use for the next crash. Step 1. They held cash when the narrative broke. Phase 1. They didn't argue with the market trend. When the trend changed, they went to cash immediately to preserve their buying power. Step 2. They ignored the false rally. Phase 2. They didn't get FOMO when the market bounced 10%. They waited for the fundamentals to bottom out. Step 3. They bought aggressively during panic selling. Phase 3 and 4. They acted when the news was apocalyptic. Warren Buffett said it best: "We simply attempt to be fearful when others are greedy, and to be only greedy when others are fearful." He meant that they buy when panic is at its highest. But you cannot do step 3 if you failed at step 1. If you don't have the cash, you don't have the option. The next crash, whenever it happens, will follow this exact same pattern. The start, the fake rally, the panic, the bottom, the recovery. We don't know the trigger yet. It could be AI, it could be debt, it could be geopolitics. But the human reaction will be identical. Your job is not to predict the future. Your job is to prepare for it, to build your liquidity, to sharpen your analysis, and to master your own psychology. If you want the toolkit to do that, to filter the noise and spot the signals before the crowd does, don't forget to check out my book. It is the manual I wrote specifically for moments like this. Scan the code or click the link below to get it from your local Amazon store. The history of the last 100 years proves one thing. The market is a machine that transfers wealth from the impatient to the patient, from the emotional to the disciplined, from the unprepared to the prepared. Make no mistake, market crashes are brutal. They bring real hardship to the economy and to millions of families. I do not celebrate that. But they are also inevitable. We cannot stop the storm from coming, but we can control where we stand when it hits. In every crash, assets don't disappear. They simply change hands. Your responsibility is to ensure that you and your family are on the side of stability, not ruin. Since you've stuck around till the end of this video, it's clear that you found this topic intriguing. And I think you'll definitely want to check out the videos popping up on your screen now. They explore even more fascinating topics in finance that might just challenge your perspective. And if you enjoyed this video, make sure to like and subscribe for more videos that break down complex and foundational topics in finance. Thanks for watching. I'll see you in the markets.